All right, let's talk about OpenDoor. We're diving into what might be one of the boldest turnaround plays we've seen in a while. We're going to break down their Q3 earnings call and unpack the new CEO's pretty radical plan to, well, completely refound the company. So check this out. On November 6th, OpenDoor's management comes out and says something that should be music to investors' ears, right? They said they're projecting a return to profitability for next quarter. You'd expect the stock to pop. But nope. The exact opposite happened. The stock tanks over 8% after hours. So what is going on here? Why would good news get such a bad reaction? That's the big question we're digging into today. All right, so let's get right into the numbers. We need to see what exactly spooked investors. Okay, so first up, the good news. And it was pretty good. Revenue for Q3 hit $915 million. That's a solid beat, coming in about $33 million higher than what analysts were expecting. So on the surface, a really strong start. But here's where things get tricky. We look at the bottom line, the earnings per share, and it's a different story. Their GAAP loss, that's just the standard accounting number, was 12 cents per share. The problem? Wall Street was only expecting a 7-cent loss. So even with all that extra revenue, they were actually losing more money than anyone thought they would be. And that's a red flag for the market. And this really paints the picture, doesn't it? You've got this great revenue beat on one side, but it's totally canceled out by that bigger than expected loss on the other. It's like one step forward, two steps back. And it's this exact kind of mixed message that makes investors really nervous. So, this is where the story really gets interesting, because to explain all of this, the new CEO, Kaz Nejatian, he didn't just come out and talk about a few tweaks to the strategy. No, he dropped a bombshell. He announced a complete refounding of the entire company. And he wasn't shy about it at all. He basically said, forget everything you knew about OpenDoor. He drew this massive line in the sand. This isn't just a pivot. He's saying this is OpenDoor 2.0, a total reboot. And this table just lays it all out, the sheer scale of this change. I mean, look at this. They're going from being this kind of slow, careful asset manager who relied on outside consultants to a fast, aggressive, founder-led software and AI company. It's a night and day difference in identity. So what's the game plan here? Well, it all comes down to speed and intensity. The whole idea is simple. Let the machines, the AI, do a better job of pricing homes. Run a much leaner company, and this is key, act like a market maker. Think of a high-frequency trader on Wall Street. You're not trying to make a huge profit on one big trade. You're trying to make a tiny profit on thousands and thousands of trades. Really, really fast. It's all about volume and tight spreads. Okay, so a bold vision is one thing. But how are they actually going to pull this off? How does this translate into a real plan to get their finances straight? Let's get into the how. First things first, they had to clean up the balance sheet. The CEO pointed to what he called a ticking clock, some risky debt that was hanging over their heads. So they moved fast. They raised almost $200 million in cash, used it to get rid of that debt, and then they did something you don't see every day. They issued a special warrant dividend. Basically, it's a thank you to the shareholders who are sticking with them, giving them a chance to buy more stock at a good price down the road if this whole thing works out. So, with the finances on safer ground, they laid out this roadmap. And this is the part that got everyone's attention. The big promise is that they're targeting positive adjusted EBITDA for Q4, like right now. And then, from there, the goal is to hit breakeven on adjusted net income by the end of 2026. And you see, this is what makes that stock drop so weird. Their promising profits are just around the corner. And getting there boils down to these three things. 1, buy way more of the right kind of houses. 2, make more profit on every single transaction. And 3, get way more efficient so their costs don't grow as fast as their business. And get this, in a really bold move, they actually launched a public website, accountable.opendoor.com, where anyone, you, me, anyone, can go and track their progress on these goals every single week. Which brings us to the bottom line, our verdict. So what have we got? On one hand, you have management telling this incredibly compelling, bold turnaround story. And on the other hand, you have the market screaming, yeah, but can you actually do it? It's all about that execution risk. And this is just a classic Wall Street standoff, isn't it? Is the new CEO a visionary who's about to pull off an epic comeback, or is the market right to be super skeptical? It really is the ultimate prove-it story. Let's break it down. The bull case, you're betting on this aggressive new CEO, you like that they've cleaned up the balance sheet, and you're buying into that promise of profits next quarter. The bear case is just as strong, though. Look, turnarounds are notoriously hard. The housing market is no picnic right now with high rates, and they're starting from way behind with a negative 7.4% operating margin. Plus, let's be honest, investors who followed this stock have been burned before. So, what's our call for the next earnings report? We think they're going to come in with a slight miss on that big EBITDA promise. Why? Well, clearing out all that old inventory from the old OpenDoor is probably going to be a drag on margins, more than they expect. And if they miss on their very first big promise, well, that's going to hurt their credibility and probably cause the stock to get kicked around some more. The real thing to watch, though, is that weekly data on their accountability website. That's going to be the real-time scorecard for whether this OpenDoor 2.0 plan is actually working. So, putting it all together, we're giving this a market perform rating. Look, the story is fantastic. It's one of the most exciting turnaround narratives out there right now, but the risk that they can't pull it off is just too big to ignore. The potential reward is high, but so are the challenges. It's the definition of a wait-and-see stock. And of course, we have to say it. This is just our analysis for informational purposes. It is absolutely not financial advice.